Mr. Mortgage back at you. It's April 4th on Friday. I'm here to talk to you about HELOCs, home equity lines of credit issued in mass by our major U.S. banks over the last 3 years. I think everybody I know has one. I want to talk about the risks to the banks, potential risks to you, and rewards, and an incredible action taken mid-month last month by Fitch to downgrade 8 of our nation's largest banks' ratings due to their enormous amount of home equity line exposure that they haven't talked about, written anything down on, but we'll go over it. I have the report right here. First of all, home equity lines of credit are just second mortgages. They're loans in second lien position that go behind a first mortgage. However, they're flexible. They're tied to prime. The rate goes up and down according with the market. They give you a credit card and a checkbook. It is the true home ATM machine. Way in the past, second mortgages were fixed rate. They were called piggybacks. And they still do that, of course. Purchases, instead of getting mortgage insurance for over 80% loan-to-value loans, you can do an 80-10-10 or something like that. I'm sure you've heard of that. But in the past few years, with the banks thirsty for lend out as much money as they possibly can for higher yield and to make sure you extract every single bit of equity you have out of your house, they took them up to 100% loan to value, $750,000 loan amount, stated income, stated asset, no appraisal, it didn't matter. If you have equity, you are going to be able to extract it through our nation's largest banks. Okay, so we have these out all over the place behind every single kind of loan out there. A-paper loans, alt-A loans, subprime loans, neg-am loans. The default rate is going up, just like on everything else. The problem here is the lenders can't foreclose. They know they can't foreclose. You don't go foreclose on a home that has no equity in it if you're in second position, because the home sells for 50 to 70 cents on the dollar at the auction, and you don't get anything. It doesn't make any sense. So the lenders are taking more traditional means. This has dropped the floor out of this market. You can't buy or sell, actually you can buy them, but you can't sell a second mortgage or home equity line if you're a lender. I'm being told the price is about 5 cents on the dollar out there for this kind of debt. So the biggest buyer actually is the first mortgage holder if they get a 30-day late and there's a second mortgage outstanding with another lender. For example, Wells Fargo has a 30-day late on one of their loans and they find out there's a second floating around that National City has. Wells calls National City, hey National City, we just got a 30-day late on one of our adjustables over here. That means you're going late too and you're not going to get a penny. Why don't you sell us that for 5 cents on the dollar? National City goes, okay. Done deal, 5 cents on the dollar. Those are about the only transactions going on right now with home equity lines. And then with Wells gets it, then they can work out a negotiation or a loan modification. They have much more leverage because they can discount that, perhaps get them into a new type of loan or do a refi or something or other by reducing their principal balance because their value is down 20% already and they can make something work, hopefully. So that's the biggest purchaser out there of home equity lines of credit. I think that pretty soon you're going to be given the opportunity to buy these back. And let me tell you why. In the past few months, the lenders are shutting them down. As a matter of fact, I'm sure you heard Countrywide about 90 days ago shut down 122,000 credit lines. Wrote borrowers who relied upon these things for retirement, for education of their children, for a rainy day fund to run their business, just yanked them, shut them down. Borrowers couldn't use any of their equity inside their home anymore. They've sent them out letters because the values have dropped. They're trying to get their arms around their exposure because it's so large. I'm talking the largest banks, Wells Fargo has $84 billion in exposure of this kind of loan product. It's enormous. It's absolutely insane. So the only way to get your arms around your exposure is to shut them down to figure out what you got so you can do inventory, right? I heard Washington Mutual shut down about 50,000 of these things. Haven't been able to verify in writing yet, but I heard from a pretty reliable source. And the other banks have got these new AVM systems to match and append their databases, and they're going through by loan to value 75 and above, looking for property values for original effective CLTV 75 and above, pulling current AVMs. And if your property values drop, there's a good chance they're going to cut you off too if you have one of these. I went down about 5 months ago and pulled every single penny out and put it in a higher yielding account, and now with the Fed cutting rates, the prime rate's down below my higher yielding account, so it's actually a profitable little move there. It wasn't for a while, but I didn't want them to take $500,000 away that I might want to use to buy property in 3 years when it hits the bottom. Nevertheless, getting back to the Fitch thing, getting back to where we're going with this, why should banks sell for 5 cents on the dollar when there's consumers out there like you and me who may want to buy these things back for 25 or 30 cents on the dollar? I'd gladly pay my bank 30, 40 cents on the dollar for the HELOC that I pulled the cash out of 6 months ago. I'm sure you would too. It would be a great deal. People would get better in their home with regards to equity. The bank, the first mortgage would have less of a chance of default. Everything would be better if people owed less money on their homes. This is one way to do it, instead of taking the default or instead of selling that loan for 5 cents on the dollar, banks. So think about that. Anyway, Fitch was concerned about the heavy exposure by the banks, so they went out in the middle of the month and put out a research report naming all the biggest banks in the country. These banks include, but are not limited to, Countrywide, Washington Mutual, First Horizon, National City, Wells Fargo, SunTrust, PNC, Chase, Bank of America, U.S. Bank, Citigroup, Wachovia, Capital One, because of their overwhelming amount of home equity lines in relation to their net asset levels and their growth from 2005 to 2007 when most of these HELOCs came on their books. You really need to check out this report. I'm going to give you a link to it because if you have a home equity line right now, there's a chance you're going to get it cut off if it's with one of these banks. However, you might be able to buy it back. That's the good news. Also, these banks have to write this stuff down. These guys haven't done it yet. Wells Fargo has only wrote down their home equity line exposure on $12 billion by 12 cents on the dollar. If I could find out where to sell home equity lines for 88 cents on the dollar right now, every single one of these banks would give them to me so I could sell them to Wells Fargo Source. It doesn't exist. More write-downs are going to have to come in this arena. It's an absolute must because the loans aren't there. They're not worth as much as they say they are. They're in second position. Most of the loans that were funded in the last 2 years are currently in a negative equity position. And when you're in a second lien in a negative equity position, the loan even becomes more worthless than the first mortgage. Anyway, I hope I helped you out. Hope you have a good day and a good weekend. If you like what I have to say, please give me a good rating on this YouTube thing. Also, if you were looking for foreclosure information, go to www.foreclosureradar.com and sign up for their monthly foreclosure report. You'll get real information so you don't have to trust all this other information comes out here. It tells you all the notice of defaults, the foreclosures, and the bank-owned properties for every single county and city in the state of California. It's real good information if you're a homeowner or an investor to find out where the risks lies and things like that. Have a good day and don't believe the hype. Here's the Fitch report I told you about. U.S. home equity woes, banks grapple with higher losses. And there's the link for you to go get it. You need to read this report. It's absolutely crucial. It tells a lot about our big banks and the health of their balance sheets. Have a great weekend.